Hello everyone, this is our third video on the same topic which we were discussing last your different accounting terms as well as your accounting principles and convention. So I hope you that you had gone through those previous videos and you understood the basics of your accounts, means those key terms. Now in this video we are going to discuss accounting principles and convention. As in earlier videos I told you that accounting principles means your basics, your those accounting norms are there on which your accounting or accounts are based. So let me just brief you that what do you mean by accounting principles. So accounting principles are the norms or rules, or you can say journal law, which are to be followed in treating various items of assets, liability, expenses and other your incomes. Means these are the basics law on which your total whole accounting are based, but this is you can say that these are called man-made. This is as good as your sciences, but not exactly science, because your science are totally based on your exactly your you can say those principles which are worldwide applicable. These principles are called accounting principles are called, these are just the basics, or you can say this is just a evolutionary process, as our accounting is just going to be widened, that some new techniques, some new basic concepts are coming. So let's start with that. First is your business entity concept. So entity, I told you earlier that entity means your enterprise. So business entity concept, it tells us that it basically gives us a distinction made between the concern and its owners. Basically means this principle says that when we are going to just enter, when we are going to record those transactions in the books of account, we just need to record only those transactions which relates to your business, not businessmen. That's why it is mentioned business and businessmen are two separate entities. What we have to consider while using this business concept, this concept just guides you. Whatever you are recording in books of accounts, that only and only should relates to your business, not to your businessman. Okay, so it means anything relates to your business that should be entered into books of account. It means next is dual aspect. Dual aspect concept is called duality concept, which we can say that your each and every transactions basically is based on double entry system, because your account is based on double entry system. Double entry means we know that one transaction is happening, that the transaction between two parties, buying and selling, should be there. If you are purchasing, it means someone is selling to you. So that's why your one business transaction, that is basically occurs between or happen between two parties. So that's why dual aspect concept is there. One is called debit, second is called credit. Duality aspect concept. Next is accounting period concept. Accounting period concept, it basically provides you that your accounts basically is based on one periodicity. Means one accounting year is there. According to concept, long life of business is divided into justifiable accounting periods. It means that once you are going to start your business, it means there should be one standardized year should be there. Means let's say you are starting your business on from 1st January. It means your accounting year should be of 12 months. That might be, you can say, calendar years, but once we say accounting always start from 1st April of any years and ends with at last next year 31st of March. This is called accounting year. If you are saying your from January 1st to December 31st, it is called calendar years. It means if you are doing your business for a very long time, for 15 years, 20 years, how could you able to record your uh, all the books of accounts for 15 years in one go. It is not possible. So that's why you need to record your business transaction only for 1 year, and you have to pay tax on that on the basis of whatever you calculated your profit or loss. Next is going concern concept. Going concern concept, it implies that concerns will be continuing the business for foreseeable future. It means your concern, your business, that is basically is for long term. It is assumed that enterprise has neither the intention nor the necessity of liquidation or of curtailing materially the scales of operation. It means it basically assumes that once we start any kind of business, it doesn't mean that we just uh, make ourselves as a negative that oh, now we have started business, so in any time my business goes interrupt or liquidated or wind up, means your business is vanished. So it is always, once we start, we assume that it is for foreseeable future. Next is cost concept. So cost concept guide you your assets and properties, means your fixed assets are recorded in the books of account at cost, means whatever the price you are paying while purchasing those, so your books of accounts should be based on that cost which you have paid to your supplier. Means if you are purchasing, let's say one take example, if you are purchasing any fixed assets like let's say plant and machinery for rupees 10 lakh, it means that 10 lakh your amount which you have paid for, that should be entered into books of accounts. So your cost concept suggests you, guides you that your each and every transactions, if you are incurring for enhancing your business value, that would be recorded at the cost which you are paying for. Next is money measurement concept. Money measurement concept, only those transactions recorded in the books of accounts which can be expressed in monetary terms. This we discussed, I think, in the meaning of accountancy, that non-financial transaction, non-monetary transactions are going to record in the books of accounts. So only money measurement, like if you're saying, we can take one example for that. Loss of a managerial personnel cannot have a specific monetary value. Means if you're any of employee or staff, just you can say that death occurs to that person, so that is called your non-monetary natures. You are not going to record those transactions. Another example, we can say that hence we can say that another transactions like anything which are not relating to your money, that would not be part of your books of accounts. So money is the basic term for that. Then we have matching concept. So matching principle is there. Matching principle suggests us that once we are going to prepare our books of accounts, it means if any income is credited in P&L account, then all expenses incurred or to be incurred for the earning this income should also be debited to same year's P&L account. It means if any kind of income which we are transferring to a specific years, let's say we are starting, or we are just taking this is just an example that we are taking our years as 1st April 2019 to 31st of March 2020. So any kind of, let's say we are selling goods of rupees 50 lakh. So it means I am saying that from 1st April 2019 to 31st of March 2020, your sale is rupees 20 lakh. So it means for getting that sales or making the sales to happen, whatever expenses you incur, let's say your expenses are for that year, means relating to your sales, is rupees 15 lakh. That should be matched with that year also. Means if you are entering that 20 lakh into 1st April 2019 to 31st March 2020, it means same year the expenses you incurred to get that sales happen of rupees 15 lakh, that should be entered into that particular year. This is called matching principle. So it means if you are entering those incomes of specific year, the same kind of expenses which matched to that years, that should be part of that particular year. This is called matching concept. Then we have accounting equivalence concept. According to this concept, assets owned by business must be equal to funds contributed by business in the form of capital. It is called your balance sheets, means sources and applications. What does it means? It means that let's say if any 1 years your resources are rupees 50 lakh. So it means you can purchase your material, your assets is about rupees 50 lakh. Means your sources, whatever funds you have, your funds should be matched to your application of funds. Means whatever amount you have, you can incur only that much amount. Let's say if your sources are 50 lakh, you cannot cross beyond that 50 lakhs, because your 50 lakh means sources equal to your application of funds. Your assets equal to liability. Always this is called assets equal to liability. Next is realization concept. According to this concept, income is treated as being earned on the date on which it is realized. Means realization concept suggests that income is accounted only when it is realized. Realized means cash is received or right to receive is established. It doesn't mean that only those transactions would be recorded that in those transactions which you are receiving cash. No. If your right of taking money is created, you can record that transaction. Means if you are selling goods on credit, it means your right is there. You can collect money after 10 days, after 1 day, after 5 days. It means your right is created. So once your right is created, or actually your money received, those transactions would be recorded in the books of account. That is called realization concept. Next is materiality concept. Materiality concept is called important or realizations. The principal emphasis that only those transactions to be recorded which are material or relevant for the determination of income from business. So any kind of transactions which are very much important, material, those should be recorded. Means if you are incurring any expenses of rupees 5 rupees, 10 rupees, those things you can avoid that. So those things are not important for that. So those transactions would not be recorded in the books of accounts. Next is full disclosure. Full disclosure says that the concept implies that financial statement should disclose all material information. So your books of accounts, it shows all the material, all the important informations. So anything which is very much important, any transaction which is very much important for your business, that should be recorded in books of accounts. Next is consistency. This principles require that accounting practices, method and techniques used by business unit should be consistent. Means if you are using any one principles to record the books of account, it doesn't mean after 1 year you are going to change. Once a particular practice is chosen, it must be used for number of years. It means you should be consistent. Consistent means regular nature should be there. Next is your conservatism or prudence. This is very much important principles. Two names are there, conservatism or prudence. This principle is nothing but a formal expression of maxim: anticipate no profits and provide for possible losses. It means in business, once we are starting any kind of business, we expect losses but not expect profit. Means once we going to start one business, it means we can say that our business might be liquidated, wind up, but it doesn't mean that you can expect profit. You can plan for that, yes, because once we are going to start any business, that is always and always based on your profitability. But still one thing is there, once you are going to continue with that, you should imagine that your business might be based on profit, but losses are always there. So we have to estimate or we have to anticipate the losses first. Losses in the first means we can say that profitability is only should be recorded in the books of account once it would be comes in your pocket. I hope you understood the things. So this is called the last principle of that your accounting principles and conventions. So whatever I just make it convey to you, try and go through this video. And if you have any kind of queries, then please mention to comment